one of the reasons why I love making these silly little market watch videos is because I love being able to refer back on the stuff that I've said earlier later on. And I made a video about how you could, what was it? How you could solve your student debt problems. And that video was in my, what is it called? My video list. And it's in there somewhere. It had like a nice little picture too. I made that not very long ago because I've been on a roll. I've been throwing out videos like left and right thanks to my iPhone. Yeah, in fact, it was called 3 Important Steps You Need to Take to Pay Off Your Student Loans. And in that, I suggested that you should consolidate, you should use a loan calculator to figure out your payments, and then you obviously have to get a job to work to, to actually afford to pay it off. The problem that we're facing is that you have a lot of students who avoid math and science, and when they go to school, they are learning things that really aren't going to help them get a job. Social sciences has basically become I'm a white person and I suck class, where they basically have you sit there and make you feel bad for being white, or they make you feel bad because you might have white privilege or something. Like me personally, I'm black. I'm a big black guy who kind of looks like Eric Gardner, and I'm fucking rich. So if you want to call that white privilege, okay, but I don't think it's going to stick because of the color of my skin. So anyway, basically what I wanted to talk about was this article that I saw. And this article was called Student Loans Don't Restrain Young Buyers. It was on Yahoo, and what I'll do is I'll post a link to it. And some of the data they got was from Zillow. But one thing I've been noticing, and you've probably noticed it too, is the declining quality of most of these articles. If you're going to write an article about mortgages, you really need to consult somebody who's actually working in mortgages. You need to consult a mortgage broker, or you need to consult somebody at JP Morgan Chase. The problem is that they try to justify what they're saying based on just the numbers. They're kind of like Samsung. They try to justify that their phone is better by saying, well, oh, Apple's got 1.8 gigabytes. Oh yeah, well, we got 2. That doesn't necessarily tell the whole story. They're saying right here that couples that owe $50,000 in student loans and have at least one master's degree have a 75% chance of home ownership. The problem is the inflated value of the homes. Now, before I talk about inflated values, I'd like to mention this right here. Sometimes it's necessary for things to actually collapse before you can actually repair them. Sometimes you can't keep the ball rolling. Sometimes the ball has to stop rolling before you can push it and make it roll again. This is the U.S. savings rate. So basically, as you see, since 1950, people's savings actually rose. And the reason why it was rising was obviously because they had come out of the Great Depression. With the war on and the war forcing people to conserve and to actually work for the war effort, our savings actually increased. So there were a lot of people who learned the importance of saving. Right around here, a little after 1980, before 1985, what you'll notice is the savings rate dramatically dropped. People stopped saving. Why? Because as the market improved, there were now more things to spend money on. There were better cars, there were bigger houses, there was more equipment, there was drugs. Drugs, for instance, a lot of people did marijuana, a lot of people did cocaine. A lot of things were made that allowed you to not to save money. In fact, the cost of fuel wasn't that high during certain periods of time, but when we had that gas crisis, price of fuel went down. Now, another problem was that the baby boomer generation, that's a whole nother story, but the kids born in the 80s. I'm actually an 80s baby. I was born in 81. But there was a lot more products for us to buy. Not only that, the government, during this time period, around the World War II, the government made it possible. They gave loans and grants and everything for people to go back to school, so that school wasn't really a cost. CUNY, SUNY, those colleges used to only cost like $1,000, $1,500. Some people only paid $75, $100 to go to school because the government made it so, we don't have a war for these people to fight, so what are we going to do with these assholes? I have an idea. We'll send them back to school. So by putting you back in school and the taxpayer subsidizing it, you were able to create a whole industry. You were able to create jobs. So as time goes on, now you get to right here, you get to like 1995, 2000, 2005. Obviously what was happening was people were saving less, they were spending more, and then the real estate bubble started showing up after 2001. Now, housing values had been going up, but the problem was in 2001, the Federal Reserve, which is a name that's going to keep coming up because they are part of the problem, the main part of the problem, they're the bottom part of the problem. They pumped all that credit into the system under Alan Greenspan after 9/11, and they made it so that when I was in college, I was walking around with $60,000 worth of credit cards in my pocket. Why would you give somebody who's 18 years old or 19 years old $60,000 worth of credit cards? Well, so I could fall into credit card debt. So basically, during my college career, I spent about $30,000 worth of credit card debt. Didn't understand how or when or why I was going to pay it back, but later on bills came due and I had to pay it back. I am happy to say that just like my video, which one? 3 important steps you need to take off your student payments. I explained in that video that I paid off my student loans, paid them off. Paid them off. 0 balances, baby. So anyway, I paid off my credit cards, I maintained 0 balances, then I paid off my student loans. What happened after I was working in mortgages as a full-time job around this time, 2005, what you'll notice right here is the savings rate had been falling, but now it dramatically started to rise. Why is that? Well, it's very simple. Because in 2005, 2006, 2007, 2008, what had happened was the housing market had burst over a long period of time. People couldn't take out loans. People couldn't spend on their credit cards because the credit windows were closed. So the savings rate dramatically rose. Look at that. Look at that shit right there. Dramatically rose. So people, because you took away their credit, because there was nobody to give you credit, the savings rate dramatically rose. The credit crisis is not over. The credit crisis, we're still in it. In fact, the Federal Reserve has done nothing more than pause the bleeding. The bleeding is still there, but there's like a little clot over the cut. We're still bleeding. We're still in pain. The thing about it is they're delaying the pain by keeping interest rates at 0. This is where I now have a problem, keeping interest rates at 0. So one of the things that I like on Facebook is Market Watch. The Market Watch on Facebook, they obviously talk about the Federal Reserve and Janet Yellen and interest rates and whatnot. So I posted a comment, which I was going to share with you. I posted a comment. In fact, I also posted that same comment in Yahoo. And let me get to it. It's a nice long comment, too. It's a really nice long comment. But I posted a nice long comment that basically states pretty much the obvious, honestly. But well, let me get back to that. I don't know where I put it. So anyway, yeah, my comment was what I felt about these interest rates. And the problem is, when I was a kid, interest rates were like 10%, and I had an account in Republic National Bank, Dime Savings Bank too. And they were earning like 10% interest so that I could actually watch my money grow. You can't really watch your money grow when the interest rates are 0 and you're getting like 0.1% interest. You can't watch your interest grow. So basically, just to share this one comment that I made, there is an inverse relationship between interest rates and mortgages. I made a little typo here, so I actually corrected it. If interest rates increase, demand for home decreases. That's what this should say, but they don't make it so you can edit. Because more potential buyers are priced out of the market. Supply of home increases because now that more people can't buy, there's more stuff out there to buy. So the prices on the homes decrease. If rates decrease, demand for homes increase because more potential buyers are allowed into the market. Supply of homes decreases. Their prices increase. We now have a multi-pronged problem. Low interest rates create low interest mortgages, which cause inflation on the houses simply because the low interest rates allow more people into the market than there should be. I personally, I know a guy who bought a house at the top of the market. He paid $500,000 for a house that should have only been like 170 tops. And the problem is, he had to get a what is it called, a modification, simply because there's no place for his house to rise. There's no value that you can add if you're in a neighborhood where the houses are only less than 200,000, but they've been inflated to 430, and that's the problem. The problem is inflation. There are many retirees facing inflation on their money. They can't afford to retire. So first of all, they're still in the market holding up jobs for people my age and people who are in the generation below me. So the problem now becomes these people should be retired, but they can't retire because they don't have enough money to retire. If they purchased a house recently or if they got a divorce, their money's all screwed up. And if their money's screwed up, they can't afford to retire. So now they're clogging up the market of jobs. Of the few jobs that are remaining, I should say. Low interest loans create more student loans. More degrees equals more inflation of degrees. That means that each degree is worth less. So if I have one English teacher who has an English degree, she's good because, you know, it's hard to find them. It's all supply and demand. So if now everybody goes to school and they're getting film degrees and all this, now the degrees are so inflated that we don't need these people because there's too many of them. It's just like when you have a leak in your house. When you invite plumbers over, you invite a couple of plumbers over and you decide who do you think is competent enough to do the job for the least amount of money. You're not going to overpay and take a haircut. You want to get a good deal. Well, everything works that way. All employers work that way. So car loans are another new bubble, replacing the student loan bubble, fast replacing the student loan bubble. If you buy a car with a 74-month payment and its depreciation is faster than the 74 months, you end up underwater on the car loan as well as your home loan, as well as your student loan. So now you've got 3 loans where you owe more than they're actually worth. What happens when a consumer-based economy can't afford to consume anymore? That's our problem. What happens when you're just moving debt around in circles? If you simply print more money or you make it easier to obtain credit to keep the people consuming, you only make the hole deeper. You ever go to a Best Buy or a Sears and you want to buy, let's say, a printer. You like one of these printers. Let's say you went in and you wanted to buy this printer right here. It's $349. Oh, wait a minute. Don't buy the printer. It's $349. We can give you this printer over here for $399. Oh, but I don't have $399. Well, we can give you a credit for $400 plus tax, and we can give you the Best Buy store card. We can give you the Macy's store card. We can make it so you can afford some shit that you couldn't normally afford. And then you end up paying all that damn interest. And the interest is what gets you. So ultimately, why am I saying all this? When I was in school, they taught me about this place called the Weimar Republic. Apparently, they decided that what they were going to do to get out of their financial crisis was to print more money. Printing more money is essentially the same thing as increasing credit, only we've done both. So when Janet Yellen says that she's not going to increase interest rates, and not only that, in the interview, if you watch the entire thing, she says that she doesn't know if interest rates will ever rise. What is she talking about? How is it that interest rates can never rise? Well, then there's another problem that you got to look at. There is another problem that you got to look at, and it's called the national debt. I'm going to make this simple. It's called the national debt clock. National debt clock, real time. You remember when Obama got into office and I think we were like 11 or 12 trillion dollars in debt? Well, guess what? Now we are $18.392 trillion in debt. So the government at this point is spending roughly $50,000 per second. That brand new Volvo XC90 that I checked out yesterday? Yeah, well, basically, they're buying one of those every single second. And they got the luxury package in it. The price per person, I think they say right here, personal debt per citizen, $52,707. You know what that means? That basically means that on your head, just for you being alive, there's $53,000, I like to round up, $53,000 worth of debt on your head. Just point at yourself in the mirror. You're worth $53,000. Understand something. With this system, your job as an American citizen is to take on as much debt as you can possibly take on without capsizing. It's kind of like playing Monopoly. It's like you buy as much property as you possibly can, hoping not to run out of money. The hope is that those properties will keep paying you enough cash out of the Monopoly bank. And I haven't played Monopoly in a long time. But the hope is that those things that you've purchased will somehow pay you enough money. They'll be appreciating assets to pay you back enough to justify all the money that you just blew on all the shit that you just bought. Problem is, if you're buying a car, that's a depreciating asset. Normally, a house is an appreciating asset, but what happens when you buy a house at the top of the market? If you buy a house at the top of the market because you had a cheap 1% or 3% loan, then you didn't buy an appreciating asset, you bought a depreciating asset. I know it takes a little time to get used to these terms, but the problem is nowadays, film degrees and liberal studies and social science classes where I have to sit and they have to tell me about white privilege, that's more important now than an economics class. That's more important than teaching people how to balance checkbooks. They could have entire math classes designed around personal finance, but instead they'd rather me sit down and watch probability and statistics. I don't care about probability and statistics. I want you to teach me about the economy. So anyway, if you haven't visited a debt clock, you probably shouldn't, because it'll just make you angry. $50,000 per second is what we're spending. You don't hit $1 trillion by accident. That's what we're really spending. And I don't know what's going to happen. Will the dollar crash? Will they replace the dollar with quote-unquote credits like they have in like Babylon 5 and Star Trek? In Star Trek, they're completely communist and they just replicate everything. They make their food and they replicate it. They just say, yeah, make me some coffee or tea, Earl Grey. And that's just it. It just beams there. Unfortunately, in real life is based on work and debt. Asia has working class poor populations larger than America's entire population. Have you ever done the numbers? Asia and India alone have over 1 billion people. That means that you're talking about over 900 million of them in poverty. Over 900 million. And that's in both countries. So you're talking about 1.8 billion people in poverty. Then you factor in Africa too. Africa's got 1 billion plus people in it. Then you factor in Southeast Asia. You're talking about, if you look at all of Asia, you're talking about damn near, between Asia and Africa, you're talking about close to 4 out of 7 billion people living impoverished. 4 out of 7 billion people who won't be able to get online next week and get their iPhone 6s Plus, like I am. So my only thing about it is, if we're moving all this debt around in circles, at what point does it become impossible to move the debt around in circles? At what point do you basically have to take the Monopoly box and close the lid and you put all the stuff back inside and you just close the lid and you put it back in the closet? And if that's the case, what happens when that happens? And these are the things that I'm concerned with.